Hey, thanks for tuning in, guys. Today we're going to talk about should I launch my deals in the vehicle of a fund or a vehicle of a syndication? Let's get into it. So, some of the things we're going to cover is the way that I have my opinion. I get asked this all the time. So, I just want to share with you when is the right time to do a fund. So, I don't know if it's right for you or wrong for you. Maybe you clear that up with your attorneys and your tax accountants. But what I want to do is just from my experience, my opinion here, I'm going to show you kind of the right entry points on depending on your AUM, depending on how much money you're going to raise or need to raise, what is the right vehicle to get that done. You can have the right sector, put it in the wrong vehicle, and the whole thing could blow up on you. Not because you chose wrong, but because you structured wrong. So we're going to talk about a couple of things. It's not legal, financial, or tax advice, just my opinion on when the best time is to launch a fund and maybe talk about some common sense areas. Leave your comments below. If you agree or disagree, let's level up together. All right, so I'm going to pull out my trusty iPad here. All right, so as you can see, should I launch a fund or a syndication? So I have different AUM or assets under management, just the total value of everything that you're managing. And what's that value at? So I know right now it's a very exciting time and there's a lot of cool things that are happening and everybody wants to be a fund manager and put that in their LinkedIn title. When you launch a fund, that actually doesn't mean you've launched a fund. It means you've scaled to a certain level where a fund makes sense. So let me explain. One of the first areas that we do is we want to look at what I like to call quadruple F. It's kind of a silly term, but I call it friends, family, fools, and followers. And so this is the first place that you want to go when you're trying to raise capital. That's typically where a lot of people go. Now, if you want to raise capital, we have a community called Fundraise Capital that teaches you how to do that. And it really solves a problem where most people are really smart at what they do, say real estate or buying dental practices, doesn't matter. They don't know where to raise capital beyond quadruple F. And so this is where you step in. So if you're going to enter a career where you're constantly doing deals, you're going to have to constantly raise capital. As I jokingly say, if you're not raising capital, then it's just a bunch of dudes having coffee over Zoom. Nothing really happens until money shows up. So the question is, what structure do I use and how do we do it? So right here, friends, family, fools, and followers, this is a great way to just get started. It works on every single level, all the way from the bottom to the top. So free game, these are people who know you. And as I like to say, if they can't know you, they can't flow you. So the next area where you want to look for capital is what I call high net worth individuals. So high net worth individuals, I would put that at right around 10 million and above. So these are essentially entrepreneurs. They're not professional investors, but they're really smart, very sophisticated. A lot of times we call them accredited investors. And these are people that maybe had a good exit or they've been flipping houses for a while or whatever it is. They got a few bucks and they're ready to send it your way as long as you are legal and compliant. Then the next area that you want to go when it comes to raising capital, and we'll show you at these levels where syndications drop off and funds begin. But you want to start looking at small family offices. And I would put those small family offices around the 25 million mark. All right, so we got small family offices. These are essentially these ultra high net worth people that maybe they got together or they really knocked it out of the park. And now they set up basically an internal operation to manage their company's wealth. So a big one would be like the Walton family office that manages the Walmart family's estate and everything. And so smaller family offices are this great bridge to go from pitching your friends and family all the way up to getting into institutions and raising money from pension funds. And so there's vehicles and there's structures. So let's just keep it simple. So I would put that at around 25 million. Then the next one is just a little bit of a nuance, but it's ultra high net worth people. Now, this is an area, arguably most of them also have family offices. So we're now tiptoeing into what I used to call individuals. So you have so much capital that they're basically an institution. So they transcend the smaller family office, and now they've actually got quite a large position. So these ultra high net worth individuals is a great place to start. But really, their entry point really comes in around 75 million AUM, right? So as you're moving up on these deals, you start to change the AUM and what these people find acceptable. Then, as you move up on the scale, you want medium to large family offices. And where I draw the distinction is small family office around 500 million AUM. And then anything above that starts to get to medium. And then a billion plus is, I would consider, a larger family office or a family office group. There's family office groups that you can also get into. And now we're really starting to tiptoe around the $100 million range. And then finally, where we want to go is institutions. So these are things like endowment funds, pension funds. You can get into other areas like sovereign wealth funds. So these are those mega funds that are California Teachers Pension Fund. That's hundreds of billions of dollars. See, everybody dreams of doing that. Now, there was a recent study that was put out that said they interviewed institutional managers and they said, at what point will you take the meeting and likely invest in an emerging fund manager? Is there a point that, yeah, at this point and above, we'll take it? And the answer actually came back. A small majority, I think 52, 54%, all agreed that if you at least have 100 million under management and you're on your third fund, then we'd probably take the meeting and talk to you. So there's a little bit of track record, and that's the next spot that I want to get into, is to say, if you want to get into what I call the Billy Club, the billion AUM and above, there's a few stepping stones that we have to step on so that they don't turn into stumbling blocks. And very often when I see people, they're trying to launch a fund and they're raising $5 million. I think that's a mistake, and we'll get into that in a minute. And so you really want to come in at institutions. You also want to be around 100, 150 million plus, right? And so what we want to do then, this is my my breakdown of where all the boxes check, okay? So we're filling in the blanks and we've got all these different sources of capital that you want to scale through. You really want to start this way and just kind of move your way up, okay? And in this area right here, let's do blue. So this area right here is the syndication zone. Now, for those of you who may or may not know, I'll keep it real simple. It's not that simple, but syndication is you're starting a corporation, you get a couple of your friends together, maybe go flip a house or whatever it is, right? Relatively small. That doesn't make them bad or ineffective. There's lots of people I interview on my show. I interviewed Chris Van Dusen, who works for Sloico Capital, not a fund. They've scaled it to $300 million and they haven't even launched a fund. So you don't feel like you have to do a fund, and hopefully a lot of this will help guide you in your decision with the professionals that you do. But this area right here, this is where you want to play, which is the sub 100 million, right? Less than 100 million. You should probably stick to that. But as you start to scale up, this is where around, let's say 100, at 100 million, you have fund one, fund two. Yes, I realized I forgot the D. And then fund three. And you keep scaling up to that. Now, this is where we go. This is the fund zone. Okay, so funds are not a thing to drive ego. Please don't have ego in this industry. I don't think that ever ends well for anybody. But what we want to do is make sure that we show common sense structure given where we're at. So if you have a small AUM, let's say you're just starting out, we've already illustrated, you want to start at friends, family, fools, and followers. Just kind of a silly term. Work your way up to high net worth individuals. So people with good exits that have a few bucks that they're willing to invest. Sometimes you can call them angel investors. And then keep working your way up. And as you can see, as your AUM climbs, you start entering different circles, right? You enter small family offices, ultra high net worth, medium to large family offices. And as you start to enter into the higher AUM and you start talking to people who want to invest in higher AUM, now you got to start changing the structure. Let's just do a quick review on what this might look like, okay? So let's just say that you have a $10 million AUM project, we'll say. And now you and your partners will like, we want to start a fund. It's going to make my mom so proud of it. It sounds so cool. I can put that on LinkedIn and everyone's going to think I'm such a boss. Well, I mean, maybe you're right, maybe you're wrong, but the real thing is that sustainable? And so, like I said, you could be really, really smart, but we got to have the right structure. Okay. So if this helps you, this is great. So let's draw a side by side comparison. So in this example, you have a $10 million AUM. On one side, you have your syndications, which on average you'd be able to charge, we'll say, a 4% management fee and do a, we'll say, 50-50 profit split. So say, hey, we're going to go flip a bunch of houses. I'm just making this up. Could be anything. And then we're going to have an exit of some point, or if you really want to be fancy, you call it a liquidity event, but it's just your exit. So we're going to have a liquidity event, and in that liquidity event, we're going to make, let's say, $10 million. We're going to double your money. We'll split that, so you'll get your principal back plus another $5 million. We'll take another $5 million. Okay, I mean that sounds like reasonably fair. You're going to have operating expenses. Let's just draw the analogy here on. So you have a fund. Now, on a fund side, you right now capital is a little bit constrained. On average, you're about 2%, but right now the market's trending around 1% management fee. Return to market, you'd be around 2, but let's stay realistic to what we're finding right now. Especially if you're just starting out, you're going to have to provide a deal somewhere for someone to roll the dice on you. So let's just say you do a 1% management fee and the common what we call 80-20 split, okay? Profit split. We're going to have operating expenses, right? You're running a business, you have OPEX. So in your operating expenses, you're going to bring in about $400,000 from 10 million AUM, assuming it's all equity. So you're going to get about 400K in the door. This one, you're going to get about 100K in the door, okay? Right now we have, let's say you have an OPEX of about 400K, right? That's not a ton. Couple salaries, maybe an analyst, and take a few investors out to dinner. And now you're kind of left with net zero. In this one, your OPEX are quite a bit higher on funds. So your OPEX is probably going to cost you about 500K. All right. Well, this is not looking good. At the small level, we're now negative in the hole $400,000 from launching a fund. Okay. So it's not looking good. But we also have carried interest. Maybe carried interest can save the day. Let's take a look. So carried interest is just another fancy term for the profits you make. So carried interest. And in here, let's just say we have that same example. So you walk away with $5 million profit, okay? And this one we have your 20%, which would be $2 million profit. Okay, well, we would net out, we'd still be okay. And then what we want to do is we just want to understand. So where does this break down? So far we've got higher carried interest on a syndication. We've got lower carried interest. So you got to float that negative 400K. And by the way, that's every year. So that's going to start to compound. So if you're in and out in 12 months, this would net out. But keep multiplying that for negative 400, negative 400, negative 400 every single year. If you're in a deal for 5 years, which is actually quite common, maybe you'll break even. In other words, you're not going to return a lot of capital to your investors. They're going to feel like you wasted their time, and this is not good. Syndications are meant for high margin, as we've demonstrated, and low volume or low AUM. And the opposite is true. So I call it the Walmart strategy, right? Still a great way to make great profits for you and people who are backing you, but it's a different strategy. It's a different vehicle. And so when you're at the smaller ones, you can actually walk away with higher profits. And I've seen a lot of people launch a fund and completely implode. And it wasn't because they didn't know what they were doing or they were bad or dishonest. They were wonderful, really smart human beings who someone gave them bad advice and they launched with a fund. And now they're actually struggling quite a bit and they just implode because, as you can see, 400,000 every year, you're either going to have to personally float that, good for you if you can, or you just shut it down. And so for most people, they shut it down or they hold on and run into some serious financial issues in case it wasn't obvious. So this one's meant for low margin at high volume. So what we want to focus on is really saying, depending on the AUM or the assets under management level that you're doing, that should drive your fundraising strategy, as we just illustrated, but it also should drive the kind of structure that you bring to your investors. Let's just draw an analogy the other way, okay? So if you had 100 million, let's draw the analogy because there's a twist here. So at 100 million, your OPEX is probably 700K. Your OPEX here is probably $1 million. Management fee is about, you would collect 4 million. And here you would collect about 1 million. That would lead your carry and your profits at about 3.3 million, or 3.3 million left over, and then carry is about 50 million. And then here you don't have a lot left over and you have 20 million. So a fund may sound like a bad idea from top to bottom. So why would anyone do it? Well, the problem is as you start entering 100 million plus, which we said is kind of that point where you maybe call your attorney and say, hey, I've been a syndicator, built it to 100 million. I want to restructure into a fund. So at there, what happens is why does anyone do it? Is because a syndication is a very good launch vehicle and a fund is a very good scale vehicle. So as you scale to the higher AUM, the market's going to reject the amount of fees and capital that you're taking in. They're like, dude, you're making too much money. I don't do that. I could go and invest in a fund which would not cost me $4 million. It would cost me 1 million. And so if you're syndicating, in my opinion, if you're syndicating too long, now we've got an issue where you're actually becoming quite expensive and no longer competitive. So now you're in the wrong vehicle for that level in the market. So you can see, as we showed, it was a bit of a spectrum that as you scale up, restructuring happens along the way. So can you start with a fund? Absolutely. But as I always say, from my opinion, if you have a fast track to $100 million, good for you. Not a lot of people do. But if you do, yeah, I wouldn't see why. Check with your attorney, of course. But if you don't have a fast track, then start with a syndication vehicle that is appropriate for where you're at and just keep building from there until you get to 100 million. Whenever that is. Could be a year, could be a decade. I don't know. But then you want to get into the place that you are, in fact, competitive. And so it's really this one here. The fund model is really where we like to play. So let's just talk, let's expand this idea a little bit further. So why is this more? Why more? Why is it more expensive, more burdensome? Well, I'll tell you. So if you want to, let's just say, launch with a syndication versus launch with a fund, okay? So we're just doing simple math, whatever's right for you. So in a syndication, typically, I'm talking about very basic entry-level stuff, typically what you'll have is a corporate entity. Corporation, LLC. And you'll also have, typically, one tax filing. Again, your lawyers and everybody structuring this will tell you. Now, on the other side, a fund typically has 3 corporate entities. This is why your OPEX is higher. This is why most people fail at the lower things, is it's actually expensive. 3 tax filings. Now, remember, you're quite regulated. And so often, what professional investors in private funds will demand are audits. So you have 3 corporate entities that you got to pay for, 3 tax filings that you have to file, and you need money that's moving between corporations, and you need professional advice to make sure that it moves where it is. Can't have misappropriation of funds. And so really what you're dealing with is elevated compliance costs. And so why would anybody want to launch a fund? Right? So if I showed you that funds are the worst thing in the world, I've failed you and you've missed the point of this video. They're not horrible. They're only horrible if they're misapplied. Well, number one, it helps you to scale. You're now entering a better vehicle suited for the level that you're at, right? So small margin, high volume. And so you have what investors like, or we call them limited partners. So what investors like is they like reduced counterparty risk. Because you're so heavily regulated, you got to act right. And if you don't, there are legal rights that investors can pursue. They are protected. So when there's that much money on the line, they really want to make sure that every dollar and penny is accounted for. And the other one is, back to the compliance issue, is increased scrutiny. Investors like that. So if you got nothing to hide, as my mother would always say, those who hide nothing have nothing to hide. When you have that increased scrutiny, you now provide those assurances to investors to say, look, we've purposely structured it this way to be fully compliant with the SEC regulations. And so from that, you can now have the assurances, even though maybe you've never heard of us, you can at least have the assurances that the way we conduct our business, given the structure we're in, you already know the rules, or your lawyers know the rules. And so we all agree on the rules, sometimes called law. We all agree what those rules are, and we all agree what the consequences for violating those rules will be. If you're doing anything less than $100 million, which I get it, sounds insane amount of money. And for many of us, it is. But I'm just telling you how it works. Anything less than 100 million, believe it or not, as crazy as this sounds, it's microscopic in the world of private funds and alternative assets. And so creating a thesis that gets you to 100 million, fast or slow, it doesn't matter. Just pick the right vehicle so that you can profit in the ways that your investors are expecting you to. And also make sure that you clear everything legally, financially, tax advice. Make sure you check with the professionals. Doing those things will help set you up for success. Violating this one easy to understand rule can get you into a lot of trouble. But complying with it, with the help of all of your tax and legal professionals, now you've positioned yourself to be successful, not only at the small numbers, but at the large ones as well. I hope this helps. Leave your comments below, and we'll see you on the next one.